Gold is on fire. Its shine brighter than ever in the world of finance. For 5 consecutive weeks, gold has been on an unstoppable winning streak, capturing the attention of investors, analysts, and everyday savers alike. The excitement is palpable, with traders on the floor celebrating each new high and financial news outlets buzzing with updates. As of Friday, September 19, 2025, gold's price continues its relentless climb, a clear signal that investors are seeking stability in a world full of economic uncertainty. The upward trend is not just a blip, it's a sustained rally that has everyone talking. The rally picked up even more steam after the U.S. Federal Reserve made a pivotal decision, cutting its benchmark interest rate for the first time since last December. This move was widely anticipated, but its impact was immediate and dramatic. The Fed's announcement sent shockwaves through global markets, causing stocks to fluctuate and currencies to shift. For gold, however, it was a powerful catalyst, propelling prices to new heights and reinforcing its reputation as a safe haven asset. On the very day of the Fed's announcement, gold surged to a record high, breaking previous barriers and setting a new benchmark for the precious metal. The momentum didn't stop there. Gold continued its steady ascent in the days that followed. By the end of the week, spot gold had soared to $3,650.14 an ounce, while futures for December delivery reached an impressive $3,683.70. These numbers aren't just statistics. They reflect a deep confidence among traders that gold's strength is here to stay. Both spot and futures prices are sending a clear message. The market believes in gold's resilience. Traders and investors are betting that the precious metal will continue to perform strongly, especially as economic uncertainty persists. The Federal Reserve's rate cut has only strengthened gold's appeal as a safe haven. In times of volatility, investors traditionally flock to gold, and this time is no different. The metal's reputation as a store of value is shining brighter than ever. Investors are more bullish than they've been in years, and the numbers back up their optimism. With each passing week, gold's upward trajectory is drawing in new buyers and reinforcing the faith of long-term holders. As long as uncertainty lingers in the global economy, gold's remarkable winning streak looks set to continue, offering both security and opportunity for those who seek it. Why does a Fed rate cut matter so much for gold? To understand this, we need to look at how the Federal Reserve's decisions ripple through the entire financial system, influencing everything from the value of the dollar to the price of precious metals. The Federal Reserve sets the federal funds rate, the foundation for all other interest rates in the U.S. economy. This rate is essentially the cost at which banks lend money to each other overnight, but its impact goes far beyond the banking sector. Cutting this rate, as they did to 4.25%, makes borrowing cheaper for everyone. Lower rates mean banks can offer more affordable loans, which encourages people and businesses to borrow, spend, and invest. The goal is to stimulate economic activity, especially when growth is slowing or risks are rising. When rates drop, it becomes easier for families to buy homes, for individuals to finance cars, and for entrepreneurs to expand their businesses. This increased access to credit can help fuel economic growth and create jobs. But a rate cut also signals that the Fed is worried about the economy's health. Investors often interpret this as a warning sign, prompting them to move money into safer assets like gold, which is seen as a hedge against uncertainty and inflation. At the same time, lower interest rates mean that traditional savings accounts and fixed income investments offer even less return. This pushes savers and investors to seek out alternatives, like gold, stocks, or real estate, that might provide better growth or protection. The Fed doesn't make these decisions lightly. Each rate cut is based on careful analysis of inflation trends, employment numbers, and overall economic growth. They weigh the risks and benefits, aiming to keep the economy stable and healthy. For investors, a rate cut is a clear signal that the economic environment is changing. It can mean new opportunities, but also new risks, as markets adjust to the Fed's actions. The effects are far-reaching, shaping everything from the interest you pay on your mortgage to the strategies financial planners recommend for your investments. Ultimately, the Fed's message is powerful and unmistakable. When they act, the entire financial world listens, and the consequences are felt by everyone from Wall Street to Main Street. Gold's reaction to the Fed's rate cut was explosive. On announcement day, Gold soared to a record $3,707.40 an ounce as investors rushed in. But markets are never one-way streets. Gold dipped 1.3% over the next 2 sessions as the US dollar rebounded. A stronger dollar makes gold pricier for international buyers, cooling demand. Still, this pullback was brief. By Friday, gold was climbing again. The quick dip was just a pause, not a reversal. Investors took profits, then jumped back in at lower prices. Gold ended the week strong, with its 5th consecutive weekly gain. The message: gold's momentum is real, and the market's support is solid. Why do falling interest rates make gold so attractive to investors? And why does gold seem to shine brightest when rates are low? Let's break down the relationship between interest rates and gold's appeal. It all comes down to opportunity cost. When interest rates are high, you can earn a solid return from bonds, savings accounts, or other fixed income investments. In those times, gold, which doesn't pay any interest or dividends, can seem less appealing compared to these income-generating assets. But when the Federal Reserve cuts rates, the returns on those safe investments shrink. Suddenly, the fact that gold doesn't pay interest isn't such a big deal, because the alternatives aren't paying much either. This levels the playing field for gold. Investors start to look for assets that can hold their value, and gold's historic reputation as a store of wealth becomes more attractive. The lower the rates go, the less you're giving up by holding gold instead of cash or bonds. So, holding gold no longer means missing out on much income. In fact, it can feel like a smart move, especially when other options are offering little in return. There's another important factor. Lower rates often weaken the US dollar. When the dollar loses value, gold prices tend to rise, since gold is priced in dollars globally. A weaker dollar means it takes more dollars to buy the same amount of gold, which naturally pushes gold's price higher. This effect can be especially strong when rate cuts are sharp or unexpected. For international investors, a falling dollar makes gold cheaper in their own currencies, increasing global demand and adding even more upward pressure on prices. Rate cuts also often signal economic uncertainty or trouble ahead. In these moments, gold's reputation as a safe haven asset comes into play, as investors seek protection from market volatility. When people worry about stocks tumbling or the economy slowing down, gold's stability and long-term value really stand out. It's seen as a reliable store of wealth when other assets feel risky. So when the Fed signals lower rates, it's a clear message to investors. Now might be the time to seek safety and stability, and gold is often the first place they look. That's why gold tends to rally when rates fall. Its unique qualities shine brightest in uncertain times and low-rate environments. The US dollar and gold are locked in a constant tug-of-war. When the dollar rises, gold usually falls, and vice versa. After the Fed's rate cut, the dollar initially weakened, helping gold hit its record. But the dollar quickly rebounded, putting pressure on gold and causing a short-term dip. This seesaw reflects global sentiment. Sometimes the dollar looks safer, sometimes gold. The dollar's rebound may have signaled confidence in the US economy or uncertainty elsewhere. By Friday, the dollar's surge paused, letting gold regain its footing. Watching gold means watching the dollar. They're deeply connected. The week's action proved how quickly fortunes can shift. For gold investors, the dollar's moves are just as important as the Fed's. The balance between these two assets shapes gold's daily price. It's a dance that never stops. A Fed Chair Jerome Powell was careful in his post-cut remarks. He called the move a risk management step, not the start of aggressive cuts. The Fed will stay flexible, making decisions meeting by meeting. But not everyone agreed. Committee member Stephen Moran wanted a bigger 50 basis point cut. His dissent shows debate inside the Fed about how much support the economy needs. Moran's push for deeper cuts hints that more easing could be on the way. The Fed's own projections suggest 2 more cuts before year-end. This internal tension keeps markets guessing about what's next. Investors are watching every word and vote for clues. Gold wasn't the only metal to benefit from the Fed's move. Silver futures jumped 0.7% to $42.42 an ounce, riding gold's coattails and safe haven appeal. Platinum held steady at $1,396.60, reflecting stable industrial demand. Copper, a key economic barometer, rose 0.3% in London and 0.2% in the US. These gains show optimism that lower rates will boost economic activity. The rally wasn't just about safety, it was about growth too. Industrial metals like copper signal faith in a stronger economy ahead. The Fed's cut lifted the entire commodities complex. Investors are betting on both stability and renewed momentum. The metals market is echoing gold's bullish tone. While the Fed cut rates, the Bank of Japan held steady at 0.5%. This contrast highlights how different economies face unique challenges. Japan's steady hand signals confidence in its current path, while the Fed acts to prevent a slowdown. Diverging policies can shift currency values, especially between the dollar and yen. A stronger yen or weaker dollar can influence gold prices globally. Investors may move money to where yields are higher, affecting capital flows. The actions of other central banks matter for gold, not just the Fed. Global monetary policy is a complex puzzle. For gold investors, watching central banks worldwide is essential. The world's financial currents are shaped by more than just one bank's decisions. What does all this mean for you? Expect lower rates on loans and mortgages. Good news if you're buying a home or refinancing. But savings account interest will likely drop, pushing you to consider other investments. Gold's surge means higher value for those who already own it, but new buyers face steeper prices. Still, gold remains a classic hedge against uncertainty and inflation. The Fed's projections hint at more rate cuts, which could keep gold's rally alive. Investors will watch every Fed move and internal debate for clues. As long as uncertainty and low rates persist, gold's appeal stays strong. Short-term dips may happen, but the broader trend looks bullish. This golden moment could have more room to run.